Welcome back to the Money and Wealth Show. I'm Sterling Fox. Our special guest this week is Ian Gordon, the founder of the Long Wave Group. And we've been talking about the Long Wave Principle, which basically has the global economy functioning in roughly 70-year cycles. We're approaching the end of the current cycle in the winter of this cycle, and frankly, the prognosis is not very good. Dr. Gordon, how do we, the individual investors, let alone a society like Canada, steel ourselves against these debt-ridden odds and survive?
Well, it's not going to be that easy because we are fairly late into the cycle, but one of the things that we would certainly advocate is that people move out of the stock market. We think that the prognosis for the general stock market is dire. We have a target that we're on record for, and which we've been castigated for that target of the Dow going to 1,000 points. So, and that's about 93% below where it was in 2000. Now the Dow between 1929 and 32 dropped 90%. So we've said it's going to drop a little more simply because the bull market of 1982-2000 was 2.5 times bigger than the bull market of 1921-29. And those two bull markets parallel each other in the autumn of the cycle. And we say the bigger they are, the harder they fall. So we think the Dow is going to be in dire straits. Well, obviously a Dow 1000 tells you the economy is in dire straits too. And so, you know, people have to get out of stocks. It's very difficult because we've been basically inveigled into believing that stocks are a lifetime investment. And
buy and hold is the mantra I grew up with.
Right. So, and if you'd done that since 1949, you'd have done exceptionally well. But you could have done the same thing essentially from 1896 all the way through till 1929 and done exceptionally well. But if you hung on beyond 1929, you got absolutely creamed because the stock market, as we said, lost 90%. And stocks themselves didn't recover for 24 years following the 29 crash. So you'd have had to wait 24 years to get your money back.
Right.
By being in the stock market. So we really don't want people in stocks, and much as, you know, the BNNs and CNBCs will, all the analysts and so on will tell people to keep buying stocks and keep getting on there. And they are in many ways far more wise than we are, but I don't think they understand this cycle. And I'd like to say that everything we have anticipated as a result of our understanding of this cycle has actually come to pass. So that I'm sorry to interrupt, but if individuals are to be dissuaded from going into the stock market, they're still looking for revenue-producing investments to accommodate their retirement needs and those sorts of things. What alternatives are there? There really aren't any, because, you know, to a revenue-producing alternative, because housing is going to drop dramatically as well. The experience in the U.S. is just a sort of a forerunner of what we're going to experience here in Canada. We know that housing prices in Canada between 1929 and 1939 dropped by 90%. Okay. So we're going to experience something pretty vicious in the housing market as well. So we don't want, you know, we would say that people shouldn't be investing in real estate. I mean, obviously, if you want to own a home and you have primary residence, and you have a lot of money, you don't have a big mortgage on that home, that's great. But the other thing is, you don't want to be carrying debt in this kind of environment, because debt is an anathema. Because we're going to see jobs lost, we're going to see an economy that's going down the drain, and so on. So that debt is a very bad thing to be carrying into a contrariety of winter. And then the thing that we've been advising when I was a broker, and we understanding where we were in the cycle, we were advising people to go to gold because we anticipated this crisis would develop and that the stocks would not perform and that gold would perform very well, because people move to gold because they're frightened. Sure. And they go to gold, and we, you know, as I say, we started to go to gold in 1999-2000. And in fact, that was really the peak of the difference, because gold and paper are always at war with each other. Mm-hmm. When paper performs exceptionally well, as it does between 1982 and 2000, the Dow going from 7,700 to 11,250, gold performs very badly in that environment because people want to be in paper because they're making money by being in paper. But then when paper performs very badly, as it is now, people want to be in gold because they don't trust paper anymore. So that between 1980 and 2000, gold goes from $850 to $250. Now it's gone from $250 to $1,250.
Exactly, yeah.
And we've been in that gold market since that time. Well, we know one way to measure it is to look at the Dow gold ratio. How many ounces of gold by the Dow Jones? And that always has massive swings when you know, so that when paper was in vogue, that ratio reached 44 ounces in July 1999. So it took 44 ounces of gold to buy the Dow Jones. And that was a peak. So then you go into gold. Now it only takes 8.5 ounces of gold to buy the Dow Jones. But we know we're going to go to an extreme, because in 1932, the extreme was 2 to 1. It took 2 ounces to buy the Dow Jones. So we've got a lot further move on the gold price and a lot further move down on the stock price that we're going to see.
Lots more information available to you on this whole matter of the long wave principle on Mr. Gordon's website, longwavegroup.com. Not the happiest conversation we've ever had, Ian, but I think a very important one as we take a look at the big picture, we take a look at our own personal survival strategies, and it's people like you who cause us to stop and think, and in these economic times, that's just not a bad thing to do. Thank you so much for being with us today. It's a real pleasure to have you on the program.
Thank you.
We'll be right back.
Good afternoon. My name is Larry Ray. I'm the chairman and CEO of Molycorp Gold Corp. As the name states, we do have a deposit we're developing in British Columbia, which is a pure molybdenum deposit. But our focus these days is on magnesium in Nevada. Through serendipity, we discovered a large deposit of magnesium running about 10% with a high purity and consists of about 256 million tonnes at this time, 52 billion pounds. Our main emphasis is to move this project forward by beginning a drill program later this year in which we can increase the integrity of the resources into the indicated and inferred, as well as increase the resource itself. For further information, please visit our website at molycorp.com or phone us at 604-531-9639.
Tax Tips with David Ingram.
There's anything I hate looking after, and it's a dead person's tax return. There's actually a special form. You can go and down to the tax office, you can pick up a deceased person's tax return. But what you have to know about the good part of it is that you get to do 2 tax returns that year. Here somebody dies, if you're looking after that estate, you get to do a tax return for all the money they received up to the date of death and all the money that they were owed up to the date of death if there were dividends or interest or something coming from bonds. So remember this, year of death, 2 tax returns. And that's a tax tip from David Ingram.
And that's our program for this week. Our thanks to David Ingram and to our special guest, Ian Gordon. And thank you for joining us. If you have some thoughts about today's show that you'd like to share with us, please send them along to comments@themoneyandwealthshow.com. I'm Sterling Fox. See you next time.
Comments made on the preceding paid commercial program are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time.